Okay, so what types of charitable trust is best to be involved in? We're going to talk about two, which are the basics. You can get very complicated with the details in how to arrange the charitable trust. I'm not going to get too far into that today, into the weeds of it all, but we're going to talk about specifically the charitable lead trust and the charitable remainder trust. Now, the charitable lead trust is really underutilized. Most people usually hear about the charitable remainder trust, which we'll save till last, but I think the charitable lead trust is a very popular trust in the sense that it should be used a whole lot more than it actually is. But here's what I mean by it. When you get or set up a charitable lead trust, you as the donor are going to contribute the cash and or the assets like the real estate to the trust itself. Now you're also going to be the trustee. Now how it works in terms of a lead trust, you're providing now income that's earned off the charitable asset to the charity basically on a fixed schedule for a term of years or for your lifetime. You get to pick either one, so if you're very elderly, then it would be normal to pick a 20-year type term that would outlast you, the trust itself. Or if you're young, then the idea would be you would want to pick a lifetime term, for the charitable lead trust. But the beauty of the charitable lead trust is that the corpus or the property that's actually put into the trust is returned to the family at the end of the term. So in this case, again, the charitable lead trust is about providing an income stream to the charity throughout the term or the lifetime. And then at the end, the trust corpus returns right back to the family itself. If you ever want to go in to see who's used trusts like this, look up Jackie Onassis. This was the family planning strategy for the Onassis family when Jackie actually passed away. Now, the other type of trust that's involved with, or we do get involved with, and most people usually pick, is a charitable remainder type trust. So again, how this is done is that the donor, you as the trustor of the trust, contributes the property to the charitable remainder trust. Now, instead of the income going to the charity, the income actually goes to you, the family, throughout the term that you pick. Again, 20 years or lifetime. Now, at the end of the term, though, the corpus of the trust, the asset, actually goes all out to the charity. Now, the beauty of both the charitable lead trust and the charitable remainder trust is you do get an upfront charitable deduction, as a result of your donation of the property or the asset to the trust. And you'll notice that in the charitable remainder trust, even though you get the upfront charitable deduction, at this moment in time, you are not giving the property directly over to the charity until the end of the term. Now, common types of charitable remainder trust. There's really two types that we work with a lot. One is a charitable remainder annuity trust, where this provides a fixed amount of income per year back to the family, even if the amount actually exceeds what has been earned by the charitable trust on the investment. So again, this will not hedge against inflation, because you do have that fixed term, but it could chew up the principal somewhat as years go by if the earnings on the principal don't match the actual fixed amount of income that you want per year. So you'll notice the last bullet on the left side there basically states that at the end of the term, you must have at least 10% of the initial trust corpus remaining in order to close out the trust term and, of course, be legal. Now, a charitable remainder unitrust is a little bit of the opposite of the annuity trust in that it provides the family a fixed percentage of the assets as income per year. So therefore, the charitable remainder unitrust hedges against inflation in the sense that every year you do have to recalculate or value the property to determine what your percentage is going to be. So valuation of property like real estate that's just sitting in the trust, producing maybe rental income, what have you, that could be a little cumbersome to do every single year, which is why we recommend that if you're going to put real estate into the trust, that we actually sell the real estate within the trust, and therefore you invest the sales proceeds, which gives you a nice brokerage account to work off of in terms of reevaluating the actual value of the trust itself every year. You'll have a nice statement that tells you, and it's very simple going forward in that regard. And one thing I haven't mentioned, I don't think, if you put real estate inside that charitable trust and then you sell it, guess what? You have no capital gains as a result of its sale. So for example, I have a lot of clients who own a home in the Los Angeles area. Well, if you own a home in the Los Angeles area and you've owned it since maybe the 1960s, you probably bought it around $30,000, but now it's worth $3 million. To sell it, you would have a huge capital gains tax hit. So one of the planning strategies would be to donate that home into this charitable type trust, sell that property within the charitable trust, no capital gain, and now you invest 100% of the sales proceeds for the remainder of the trust. Now again, you must leave at least 10% of the initial trust corpus in the trust at the end of the term in order for it to be legal and pass, all the scrutiny of the IRS, etc. Now, one of the problems with the charitable remainder trust, if you think about it, is that charitable corpus is ultimately going to end up going to the charity. It does not come back to the family. Yes, the family gets income off of it throughout the term, but they do not get the trust corpus returned to them like in the charitable lead trust they do. So how would you want to replace the wealth that you are now giving to charity for your family? Well, one of the ways is to take that income stream that you're getting every year off of the charitable remainder trust and invest in it into a life insurance type policy, which will of course have a death benefit. And then that death benefit just so happens to equal the amount or close thereto of what you've donated into the charitable remainder trust that ultimately is going to go to the charity. So what you've done by taking that income stream and investing in a life insurance policy, you're in a sense replacing the wealth. And so this is a typical planning tool. It's used quite a bit with our families that can get involved in these charitable remainder type trust. And the beauty of it is not only is charity, benefiting, but so's the family. The family gets a return of that donation through the life insurance policy.